In these programs, you will learn about procedures which are applicable to a wide variety of organizations, including proprietorships, corporations, associations, and independent divisions. Since most accounting is performed for profit-seeking persons or companies, much of the discussion will be presented from their viewpoint, but most of the procedures you learn about will apply to other organizations. Accounting is an activity which records and presents the results of financial transactions. An accountant also helps interpret these results. Bookkeeping refers to the appropriate recording of transactions, whereas accounting also includes the professional aspects of the design of records, analysis and interpretation of data and reports, and policy recommendations. What organization do you think most accountants work with? Yes. Bookkeeping means the recording of transactions, while accounting includes professional review. What does an accountant do? Right. In addition to the owners, directors, and managers of an organization, banks and other creditors, such as suppliers, depend on the reports which are prepared by a capable accountant. And increasingly, government agencies at local, state, and national levels are requiring information obtained by accounting methods. Accounting is the language of business. It communicates important facts about an organization to those who need to know. Accountants may work in public, private, or government accounting. A certified public accountant, or CPA, is one who receives a license by passing a very rigorous test in accounting theory, accounting practice, auditing, and business law prepared by the American Institute of Certified Public Accountants. Public accountants may be required to obtain a license to practice accounting. Who needs to know accounting facts about an organization? One of the major activities of accountants is auditing, which is checking the financial records of an organization with certain tests for accuracy. The accountant also performs certain management advisory services for which their training and experience has qualified them. The first stage of accounting is the recording of transactions such as sales, purchases, loans, or receipts for money, all of which is normally done by a bookkeeper. It may be by hand in a record book, but today it is often performed by keyboard into a bookkeeping system, or by making a recording on a punched card, a paper tape, a magnetic tape, or otherwise, so that a computer may process the entry. Another accounting step is classifying, or grouping similar entries together for convenient review. Summarizing is a function which brings various pieces of information together for study. Before classifying and summarizing, what is the first step of accounting? Yes. When a financial transaction occurs, like the purchase of some supplies for cash, it must be recorded. Periodically, such recorded accounting entries are grouped for review. This is classifying. What do we call the step which brings accounting information together for study? Yes. The assets of a firm are those things of value owned by the firm. These include cash, merchandise, furniture, machinery, buildings, land, accounts receivable, and notes receivable. Accounts receivable are amounts owed by customers and others without written formal promises to pay, and notes receivable are the sums owed to the organization, represented by written promises with specified dates and amounts. Some usual kinds of assets are money, inventory, automobiles, real estate, and money owed by others to the organization, called accounts receivable. What is an asset called when money owed to the firm by others is shown by written promises? Right. Liabilities are the obligations or debts of an organization or person payable to others. The most common kinds of liabilities are accounts payable, notes payable, taxes payable, and salaries payable. Accounts payable are debts normally to suppliers, which are not represented by specific promises and due dates. Notes payable are written and signed promises to pay a stated amount on a specific date. Remember, accounts payable are owed without a written promise to pay. What do you call a debt with a written and signed promise to pay on a specific date? There are three elements of accounting: assets, liabilities, and equity. If it is to operate properly, an organization should have more total assets than total liabilities. The difference between these totals is called the equity of the owners. If the assets total $100,000 and the liabilities are $60,000, the equity is $40,000. Sometimes the terms net worth or capital are also used to mean the owner's equity. What are the three elements of accounting? Yes. Accounts payable and notes payable are liabilities. They are debts which must be paid. What are accounts receivable and notes receivable? Yes. Since equity is the difference between assets and liabilities, another way of saying this is that total assets equal total liabilities plus total equity. If total assets are $100,000, the liabilities may be $60,000 and equity $40,000. Also, if the total of all liabilities and all equity is $100,000, then all assets equal $100,000. These are different ways of expressing what is called the accounting equation. From a logical point of view, however, since owner's equity after a period of operations is just whatever is left over from subtracting liabilities from assets, the equation may be written assets minus liabilities equals equity. But it is customary to show assets on one side with liabilities and equity on the other side of a report. Two forms of the accounting equation are shown here. Assets minus liabilities equal owner's equity, and assets minus equity equals liabilities. What is another form of the equation? Right. Assets and liabilities change frequently when supplies are purchased or expenses incurred. But there are only two ways that owner's equity can change. First, from changes in the total investment, such as paying in some capital or withdrawal, if corporation dividend, and secondly, from operations which result in profit or loss. In each case, there will be a change in the assets or liabilities, or both, since there must be a change in the difference between them, which is the equity. Capital or equity can change in two ways. One is by profit or loss from operations. What is the other? Right. A transaction is an activity of the company which involves some change in its assets, liabilities, or equity, expressed in financial terms. Buying equipment or materials, paying a creditor, selling goods or services, or receiving payments are typical transactions, which can be small or quite large. A transaction may affect one, two, or all three of the accounting elements. This could occur when the asset cash is paid for the asset merchandise at the time of purchase. More often it affects both liabilities and assets, such as inventory and accounts payable. If you sold an asset which was shown as worth $100 in inventory and you received $200 cash for it, There would be changes in 2 asset accounts and one more change. What other main element of accounting do you think would be changed? Right. Now let's start up a company. If General Energy Devices was incorporated and $10,000 cash was invested by its shareholders, it would have assets of $10,000 in cash, no liabilities, and invested capital of $10,000 shown as owner's equity. Why aren't there any liabilities? Yes. The transaction of establishing General Energy Devices by depositing $10,000 in the bank and issuing $10,000 worth of capital shares to the owners does not yet involve any debt. Later equity investment by owners is a similar non-liability transaction. When transactions are recorded, the odd cents are entered. In many periodic financial reports, for simplicity and convenience, only even dollars are shown. GED now buys $1,200 worth of equipment on an open account, payable in 30 days. In this transaction, there is no change in cash or equity, but there is an increase in assets and an increase in liabilities of an equal amount. The asset account called equipment is increased $1,200, and the liability accounts payable is increased by the same amount. The company now has $10,000 cash, $1,200 of equipment, $1,200 of accounts payable, and $10,000 of equity capital. This was the result of 2 transactions. What kind were they? Yes. Another kind of transaction can increase one asset account and decrease another. For example, if the company bought $500 worth of supplies for cash, the asset account supplies would be increased to $500 and cash decreased by $500. When an organization purchases with cash something which is kept as an asset, is there a change in liability or in equity? Right. But a change in an asset is usually accompanied by a corresponding change in liabilities. For example, GED Company may pay $600 for equipment already purchased and recorded in accounts payable. This would decrease cash by $600 and decrease accounts payable by $600. You've now seen 4 examples of the numerous kinds of transactions. An investment which increases assets and equity, a credit purchase which increases assets and liabilities, a cash purchase which increases one asset and decreases another, and a payment which decreases an asset and decreases liability. Do you think there could be a transaction other than investment which would affect 2 kinds of assets and equity? Yes, the firm could sell something for more or less than the amount listed on the asset accounts, and the profit or loss would change the equity. Another transaction might be the sale of services for cash, at which time the salary of the employee who performed them might be set up as a liability, and the difference, if any, would be a profit or loss adjustment to equity. Kinds of transactions are entered periodically. This is done for convenience, as it would be too costly and time-consuming to put the cost of 1 hour's work by an employee, 1 postage stamp, or 1 telephone call. Individual sales of major assets can be offset by reduction of an asset, but sales of services are usually accumulated and offset by salaries paid during an accounting period. In the same way, expenses are accumulated, and when a statement for expense is received and entered into the account, the equity is reduced unless there is a specific offsetting increase in assets. At the end of the first week of business, we will say that GED Incorporated has $8,900 in the bank, $500 worth of supplies, $1,200 worth of equipment, and $400 in accounts receivable for services which were sold. Total assets, $11,000. Liabilities are $600 in accounts payable owed for equipment, and $250 owed for employees' salaries, and $50 for other accrued expenses. Equity is $10,000 of capital plus $100 of earnings. What is the total of liabilities and equity? Right. Here's the statement. It is called a balance sheet. It shows the condition of the company at a certain time and is sometimes called the statement of condition. As you can see, the total assets equal the total liabilities and equity. If they didn't balance, we could assume the assets and liabilities are shown correctly and a profit or loss was incurred. We would then adjust equity for this amount, making both sides balance. What item of equity would probably be changed? Yes. Another periodic statement is the income statement, also called the profit and loss or operating statement. Here you see that in the first week of operation, only $400 of sales were made for services. The expenses shown are for salary expenses and other expenses. For any real organization, there would be at least 20 or 30 expenses for rent, telephone and other utilities, depreciation, overhead expenses, including legal and auditory expenses accrued, various taxes, including unemployment, Social Security, and income, several kinds of insurance, including workman's compensation and public liability, licenses, fees, transportation, employees' benefits, and reserves, for a number of other expenses to be accrued. For the moment, these are merely included in accrual accounts. You should remember that the income statement refers to a period of time, while the balance sheet refers to a point in time. The balance sheet might be dated as of December 31st, 1976, or as of June 30th, 1977. But the income statement would state for the week ending September 15th, or for the month ending November 30th, or for the year ending December 31st, 1977. By accounting, you can record financial transactions and present these results. These results may be presented to the owners, managers, creditors, and government. The steps include recording, classifying, and summarizing. Transactions are financial events. They are recorded, classified into accounts such as cash, accounts receivable, supplies on hand, inventory, and equipment, which are assets, and accounts payable, notes payable, and other debts or expenses accrued, which are liabilities. Retained profits and invested capital make up the owner's equity. Total assets equals total liabilities and equity. What sort of statement shows this equality? In this program, you've learned some of the basic concepts of accounting. They've been presented very rapidly, so you should repeat this program at least once.